Welcome to the week that was. If you've been tracking assets globally this past week, well, it wasn't just another news cycle, was it? It really felt pivotal.
Yeah, like a convergence. We
Yeah.
saw these three massive structural forces, ones that have been building for a while that just bam, hit all at once.
Exactly. You had global monetary policy starting to ease up. Then this really unprecedented regulatory clarity coming out of the U.S.
And just sheer volume of institutional capital. I mean, levels we haven't really seen sustained like this before.
So that convergence, that's what we're unpacking this week. We saw Bitcoin, it started the week kind of stuck, consolidating around $115,000. Bit nervous, maybe?
Definitely waiting for a signal. But by the end of the week, totally different picture. It broke out of that tight range, successfully pushed up, and tested that $117,000 to $118,000 resistance zone.
And here's the kicker. The thing that really stands out to me, it completely defined history. Bitcoin actually posted, what was it, about an 8% gain month to date?
Right. And anyone who's been in crypto for a cycle or two knows September. Well, it's usually feared.
September, yeah. Historically, it's Bitcoin's weakest month by far.
So the fact that it just absorbed that historical headwind, that seasonal weakness, and still climbed, that tells you something fundamental has shifted in the demand picture.
The buyers just stepped in.
Overwhelm the sellers. Simple as that.
Okay, so the big question we need to tackle for you listening in is, what exactly were these forces? Why did they manage to power past that historical trend this time? And crucially, what does it mean for that big $120,000 level everyone's watching?
Well, you have to start with the biggest engine in the room, right? The Fed.
The U.S. Federal Reserve.
Yeah.
Yeah, their decision seemed to overshadow almost everything else.
Absolutely. It was the dominant factor. Now, the actual rate cut itself, that was mostly priced in by the markets, but it was the narrative shift from the FOMC, the committee, that was key.
Okay, so walk us through the action. First rate cut since what, December 2024?
That's right. They trimmed the target range by 25 basis points, 0.25%. So the new range is 4.00% to 4.25%.
But you said it was the narrative, the language from Chair Powell. What was different? What caught the market's ear?
It was just how dovish it sounded. Powell specifically framed this cut not as, hitting the panic button, but more as risk management.
Risk management meaning?
Meaning they're worried. He explicitly pointed to the U.S. labor market starting to look shaky. Non-farm payrolls, get this, averaged only $27,000 per month between May and August.
Wow, okay.
Yeah.
That's a tiny number compared to previous periods. A real slowdown.
A sharp slowdown. So the Fed's seeing that potential weakness.
But hold on. If the Fed's cutting because jobs are weak, isn't that usually bad news? Doesn't that scream recession risk? Why did Bitcoin rally on that instead of getting hit by a risk-off wave?
That's the really interesting part. It's about the interpretation. The market seems to be increasingly viewing this through maybe a stagflation-like kind of lens.
Slow growth, but still sticky inflation.
Potentially, yeah, or at least the risk of it. And when the Fed confirms they're on an easing path and their own forecast, the dot plot, it now shows 2 more 25 basis point cuts expected by the end of 2025.
Okay, so they're signaling more cuts are coming.
Exactly. And for big institutions, that signals, okay, dollar purchasing power is likely to keep eroding. So where does liquidity flow?
Into assets perceived as hedges or higher return potential, like Bitcoin.
Precisely. Even if growth is sluggish, the easing itself pumps liquidity and reinforces Bitcoin's role as a hedge against that dollar debasement. So the Fed provided let's call it the macro tailwind.
Got it. More fuel for the fire.
And just as that was happening, you had this huge shift on the regulatory front over in the U.S.
Right. This is where things got really structural, I think. The SEC, the main regulator, didn't just approve another Bitcoin ETF. They did something much broader.
Much broader. They approved generic listing standards, basically a common rulebook for commodity-based ETPs that's exchange-traded products, and crucially, that explicitly includes spot digital asset products.
So instead of every single crypto ETP needing its own bespoke, lengthy review.
Exactly. Now there's a standardized, rules-based framework. Think of it like creating a highway instead of approving each car individually.
What does that mean practically? Faster launches.
Much faster. This is the fast track effect people were talking about. It basically removes that huge bottleneck of custom reviews. The talk is it could shrink the launch timeline for new compliant ETFs down to maybe 75 days.
And we saw results immediately, didn't we?
Instantly. The Grayscale Digital Large Cap Fund, GDLC, it got the green light and started trading almost right away.
And that one's interesting because it's not just Bitcoin, right? It's diversified.
Yeah, it gives professional investors exposure to a basket. It's mostly Bitcoin, about 72%, but also has Ethereum at nearly 17%, and some others. So, boom, multi-asset crypto ETP is alive.
But then Grayscale made another move, kind of a strategic poke, maybe?
Yeah, you could call it that. A real chess move. They immediately used this new framework to file an updated S1 form for a spot Dogecoin ETF, ticker GDOG.
Okay, wait. Dogecoin, seriously. Why lead with Dogecoin to test a major new regulatory framework? Seems unexpected.
It seems unexpected, but it's actually very clever. Here's why. The new framework, the rulebook, it has specific criteria. One key requirement is that the underlying asset needs to have had a regulated futures market, like on the CME, for at least 6 months to qualify for this faster rules-based path.
And Dogecoin.
Dogecoin just meets that 6-month threshold for its CME futures. So by filing for GDOG, Grayscale is essentially forcing the SEC's hand.
How so?
They're asking, is this new framework truly objective and rules-based? Meaning, if an asset checks all the boxes, like having regulated futures, does it automatically qualify for the fast track? Or is the SEC still going to apply some subjective judgment, maybe limiting approvals to just Bitcoin and Ethereum for now?
Ah, I see. So they're testing the objectivity of the rule. If it meets the criteria, it should pass.
Yeah.
Regardless of whether it's Bitcoin or, well, Dogecoin.
Precisely. It effectively makes the regulated futures exchanges, like the Chicago Mercantile Exchange, the new gatekeepers. If the CME deems an asset stable and liquid enough for institutional futures trading for 6 months,
then the SEC's own rules suggest the spot ETF should follow relatively quickly.
wow, okay, that clarifies things massively for potentially dozens of other assets down the line.
It's a huge clarification. The whole conversation shifts from, is this specific coin worthy, to does this asset meet the objective technical requirements? That's institutionalization happening right there very quickly.
And you mentioned the UK, too. Seems like global clarity is converging.
Yeah, briefly. The UK's FCA also released new proposals moving towards full regulatory oversight, kind of mirroring frameworks like MiCA and the EU. So you're seeing this global trend towards clear rules.
Okay, so we've got the Fed easing, providing liquidity, and the SEC basically opening the regulatory floodgates with clear rules.
Right.
That brings us to the third leg, institutional demand. Did the money actually show up? Oh, it showed up big time. It was a demand shock, really. Just looking at the U.S. spot Bitcoin ETFs, cumulative net inflows for the week were around $2.38 billion.
$2.38 billion in 1 week. Let's put that in perspective. How much Bitcoin is that?
That translates to roughly 20,685 BTC flowing into these institutional products.
20,000 Bitcoin. And how does that compare to, say, the new supply coming from miners?
That's the stunning part. That institutional inflow outstripped the new Bitcoin mined over the same period by a factor of nearly 9 to 1.
9 times.
Yeah.
Wow, so institutions are just absorbing almost everything miners produce and then some.
They're essentially vacuuming up the available supply. And that demand pushed the total assets under management, the AUM, for all the U.S. spot Bitcoin ETFs combined past $150 billion.
Incredible numbers. But you mentioned earlier, it's not just about the amount of money, but how companies are using it. Moving to phase 2.
Exactly. We're seeing more sophistication beyond just buying and holding Bitcoin on the balance sheet. Yes, you still have the big accumulators, like Strategy, formerly MicroStrategy. They added another 525 BTC this week. Their stack is just enormous now, over 638,000 BTC.
Still the leader in accumulation. But where's the sophistication coming in?
Look at a company like Hyperscale Data. They launched a $100 million Bitcoin treasury strategy, but they explicitly linked it to their business. They're aiming to hold Bitcoin equal to 100% of their market cap.
So it's not just a reserve asset, it's tied to their actual corporate value and strategy.
Right. They're signaling alignment with a Bitcoin-centric future for their data infrastructure business. It's becoming a strategic tool, not just passive holding.
And we also saw something tackling that age-old institutional problem. Assets need to generate yield. Right?
Yes, this was significant. Valor launched a product on the London Stock Exchange, the One Valor Bitcoin Physical Staking ETP.
Staking ETP, how does that work?
It basically allows professional investors to buy an ETP that holds physical Bitcoin, but it also generates a yield currently around 1.4% annually through staking mechanisms.
So it turns Bitcoin, which traditionally doesn't produce cash flow, into a yield-generating asset within a regulated wrapper.
Exactly. For conservative funds, pension funds, endowments that need income generation from their assets, that makes Bitcoin suddenly much more palatable. It removes a major psychological barrier.
Makes sense. It also feels like the market is getting smarter about how it values companies that just hold Bitcoin. That treasury premium seems to be shrinking.
Yeah, we're definitely seeing that compress. Historically, if you were an institution wanting Bitcoin exposure before the ETFs, you might buy shares in a company like Strategy, even at a premium to its Bitcoin holdings.
Because it was the only way to get exposure easily.
Pretty much. But now,
Yeah.
you have multiple low-fee, highly liquid spot Bitcoin ETFs readily available on major exchanges, so why pay that extra premium for a proxy stock that also carries its own company-specific risks?
The financial plumbing is cashing up. The direct instruments are now available, so the imperfect proxies become less attractive.
It's just a natural market evolution. The tools are finally matching the asset.
Okay, let's shift gears slightly. All this institutional buy-in, it relies on the underlying tech actually working and scaling, right?
Mm-hmm.
Are we seeing progress there?
We are, and that's crucial underpinning. Look at Layer 2 solutions, especially the Lightning Network designed for faster, cheaper Bitcoin payments.
We hear a lot about Lightning, but is it getting real use?
Tangible adoption, yes. Chipper Cash, which is a big fintech platform in Africa with millions of users, they just announced that over 50%, half of their Bitcoin transactions, are now happening over the Lightning Network.
Wow, okay. That's not a test case. That's real volume on a major platform. Proof it works for everyday payments at scale.
Exactly. It shows it can function as that low-cost payment rail people have hoped for.
And what about the miners? We've talked before about them potentially pivoting their infrastructure skills. Any news there?
Huge news, actually. A massive validation of that pivot strategy. Nscale, a company spun out of the mining firm Archon Energy, they just announced a major partnership
With who?
with Microsoft, Nvidia, and OpenAI.
The AI giants. What are they doing?
Nscale is leveraging its expertise in securing low-cost power and building large-scale data centers skills honed through crypto mining to build a massive AI supercomputing facility in the UK.
Ah, so they're taking their core mining infrastructure know-how and applying it to the booming AI high-performance computing sector.
Precisely. It confirms that business model pivot. Miners aren't just miners anymore. Their infrastructure and energy expertise are incredibly valuable for AI, which is desperately power-hungry.
That's a smart strategic move. Now, while Bitcoin's ecosystem seems to be maturing, we did see some issues on other chains this week, didn't we?
We did,
Yeah.
and it actually serves to highlight Bitcoin's strengths in a way. We saw Monero, the privacy coin, suffer a significant blockchain reorganization. 18 blocks got rewritten. That's a serious security issue.
A potential double spend scenario.
Exactly the kind of thing a 51% attack can enable, which is what seems to have happened there. And then the Shibarium bridge, related to Shiba Inu, also had a security compromise.
So how does that contrast with Bitcoin?
Well, these kinds of failures, a chain reorg on Monero, a bridge exploit, they underscore the relative security and robustness of Bitcoin's base layer. Bitcoin's massive decentralized proof-of-work network makes that kind of 51% attack incredibly difficult and expensive.
So it kind of reinforces the flight to quality argument within crypto.
Mm-hmm.
Institutions see these issues elsewhere, and it makes Bitcoin's track record look even more appealing.
I think that's definitely part of the narrative. The battle-tested security of the main Bitcoin protocol is a key reason why it attracts that serious institutional capital first and foremost.
Okay, so summing up, we've got Fed liquidity, regulatory green lights, massive institutional inflows, real-world scaling, minor pivots. It all sounds incredibly bullish internally, but you still mentioned a caveat, an external risk.
Yes, and we can't ignore it. The big dark cloud remains the broader macro picture, specifically recession fears.
Still lingering.
Deepening, actually. The U.S. leading economic index, the LEI, it tracks forward-looking indicators. It fell again in August, down 0.5%. That suggests underlying economic weakness.
And if that weakness finally tips into a proper recession, triggering a big market sell-off.
Then you get a broad risk-off event. Panic selling across the board, stocks, bonds, everything. And in that scenario, Bitcoin, which has become pretty highly correlated with risk assets like the Nasdaq lately.
It likely gets dragged down too, at least in the short term.
Yeah.
Regardless of its own strong fundamentals.
Exactly. The structural bid from ETFs might provide a cushion, but a large enough wave of generalized panic selling could definitely overwhelm it temporarily. Correlation is a powerful force in a crisis.
So that's the tension. Huge internal strength meeting potential external weakness.
Yeah.
If that risk-off event does hit, where are the key levels you'd be watching on the downside for Bitcoin?
If we lose the current support around that $114,000, $815,000 area we discussed, the first major line in the sand is down near $101,000. That's a significant psychological and technical level.
And if 101K doesn't hold?
Then the next critical zone comes into view around $94,000. Those would be the key downside targets to watch if the macro picture really deteriorates sharply.
Okay, so that really captures the essence of the week that was.
Hmm.
This palpable tension. Massive internal drivers pushing Bitcoin up, meeting these persistent external macro fears.
Absolutely. So to help you track how this tension might resolve in the coming days and weeks, we've got maybe 3 key signposts for you to keep an eye on.
All right, let's hear them. What should people watch?
First, just technically watch the price action right around that immediate support level, the 50-day exponential moving average, the EMA. It's hovering near $114,800 right now.
So that's kind of the short-term institutional benchmark. If it holds above that, the bulls are still generally in control for now.
That's the idea. A stronghold there would be constructive. Second, keep a very close eye on the SEC, specifically any formal response or guidance they issue about that Grayscale Dogecoin ETF filing.
Because that's the litmus test for the new rules.
Exactly. Their decision, or even just their commentary on it, will tell us a lot about how objective and broad that new fast-track framework will truly be in practice.
Makes sense. And the third signpost.
Keep watching the money flow. The institutional demand needs to stay strong. Monitor those daily and weekly net inflows into the U.S. spot Bitcoin ETFs, as long as that demand keeps significantly outpacing new miner supply.
That structural floor we talked about should remain pretty solid.
Correct. Consistent positive inflows are key to absorbing any selling pressure.
Okay, clear signposts. Before we wrap up, let's leave our listeners with that final provocative thought, something to chew on.
Right. Think about this. The SEC's move with the generic ETP standards, and Grayscale immediately testing it with Dogecoin. It really proves the regulatory conversation has fundamentally shifted.
How so?
It's not really about if crypto products like ETFs should be allowed anymore. The SEC's own rules now imply it's about which products must be allowed, as long as they meet objective, defined criteria like having a regulated futures market.
So the barrier has moved from subjective approval to objective qualification.
Precisely, and that begs the really massive question for the entire financial industry. Now that these systematic regulatory barriers are being dismantled, rule by rule, how quickly will Wall Street move to fully integrate this entire new digital asset class into everything they do? It feels like the starting gun for that integration just fired.